And we do have one other product. If you have borrowers that are higher net worth, that have a good amount of money of assets, we have a product where we can use those assets and not use any income, no employment verification or anything else, and just qualify them off of those assets.
You're
Right?
talking about, there are two programs. You're talking about depleting assets?
No, so asset depletion is different. This is asset qualifier. So asset depletion.
Describe to us, please.
Mhm. Did you have a question?
Yes, describe to me, please.
Oh. So asset depletion, you do have assets, but you're also using income to qualify, and you're going to meet a debt ratio. That's
okay.
Asset depletion. Asset qualifier, you're not going to use any income. There's no debt ratio. You're only qualifying off of the personal asset. So this one works well when people haven't filed their taxes, or they're in the middle of, transferring jobs, or they just started a new business, or maybe they just want to fast track their loan and they don't want to do all the red tape. They don't want to order transcripts, order VOEs, or any of that stuff, right? Because
let me give you a specific example. Let's say let's say somebody has $1 million. Okay. So how will you calculate? What you going to be calculating?
So I'm going to say, okay, those $1 million has to be personal assets, first of all. It cannot be, it can be things like checking, savings, CDs, money market accounts.
Stock market?
Stocks. I have a list of all the assets right here.
Okay.
And everything that you can use. You can use retirement as well, 401k, IRA.
Mm-hmm.
And what I need is 20% down for the loan. So let's just say that they're buying a home and they need, $200,000. So from that $1 million, if we were able to use all of it, $200,000 is their down payment. So they have $800,000 left that I can use to qualify them, right? I'm going to take this $800,000 and I'm going to split it over 5 years, which is 60 months. Okay. Then that gives me a monthly budget. And I have to stick to this monthly budget with 3 things. I'm looking at 3 things that I need to calculate. Okay. So number 1, I have to make sure that I can include the new mortgage payment in that, the new mortgage payment that we're giving them. Let's just say it's an $8,000 mortgage payment. I have to include everything on their credit report. If they have a car payment, if they have credit card payment, right? All that stuff. And I have to make sure that I can include at least $2,000 for personal expenses. And as long as we had enough money to cover those 3 things, then they are eligible. And you'll see here, it's just 3 things that they need to cover. The new mortgage payment, everything on their credit report, and at least $2,000 of personal expense.
When you say mortgage payments, you mean principal, interest, tax, and insurance?
Yes, PITIA.
PITI. Okay. So I've heard about this program. It's a very interesting twist.
Yes.
But you added something which I didn't hear before, that you can just liability. But how about credit card liabilities?
Yes, all the credit liabilities.
Okay, so monthly, now was everything with the monthly liabilities.
Yes.
Plus $2,000 plus PITI. This has to be equivalent to whatever is this balance divided by 5 is going to be.
Yes.
Divide by 5 and divide by 12.
Just
60, basically.
Multiply by 5 years, which is 60 months.
Yeah, 60. So basically, you divide this by 60.
Yes.
The balance, whatever it is, you divide by 60, and this will be amount. So let's say if I have 600,000, divide by 60, it leaves 10,000, right?
Yes.
So 10,000 is my monthly allowance. So this 10,000 has to cover PITI, liabilities, and 2,000.
Yes.
So okay.
Exactly. And I listed it right here. It just has to cover those 3 things: your new payment, everything on your credit report, and $2,000 in personal expense. So you can do it the other way too. You can say, okay, I have 2,000 in expenses. My credit cards and everything on my credit report is 2,500, and my new mortgage is going to be 6,000. So I'm going to take that and multiply it by 60 months. I need $630,000.
You're doing it in reverse.
Very, very simple product.
And can the part of this amount can be a gift or
No. No.
everything has to be their own money.
Yes. Everything has to be their own asset.
At the time of closing, basically.
Yes, and we're looking for the assets to be seasoned 6 months.
So you answer my another question, which I problem. No, I'm trying to cheat the system.
So yeah, we're looking for the assets to be seasoned.
At least seasoned for 6 months.
Yeah. But
okay.
This loan, it can close in 10 days, 14 days. Because imagine there's no income condition. There's no income that you provide. There's no debt ratio, no transcripts, no VOE. You don't have to wait for all that stuff to get done. You're submitting your assets, you order your appraisal, and bam, you get your loan.
And limitations on credit score?
700 minimum.
700 and 20, you said 15% down can be?
20% down?
15 or 20?
20% down.
20, okay. So it has to be at least 20% down. Credit score is 700 and balance divided by 60.
Yes.
Yeah, I got a question. So you qualify with these assets, and after the loan closes, is the borrower eligible to liquidate the assets, or, I mean,
What they do after our loan closes, we don't follow up on that. We're not checking to see, what they're using it for, or if they're using it, or,
yes. So in other words, it's just a qualifying tool. It doesn't really signify that these assets are going to exist in the form they were presented for 5 years, right? They're not tied up or anything like that.
The reason that we ask for them to be seasoned is because that kind of gives us an idea that money has been there and stable. But obviously, if the borrower decides to use it and invest.
Yeah. No, I just wanted to clarify that. I think that's an important point, though, to bring up.
Yeah, it's very interesting tool, which I'm going to do for my Wednesday presentation. Yeah.